What's going on, everybody, and welcome to Investing Alpha. And in this video, we're going to be talking about options trading, what are options, and how to be an expert options trader, different things that you're going to need to know, even the Greeks, when it comes to option stock trading. So before I go any further in this video, all I ask that if you enjoy this type of content, if you enjoy stock market investing, and just learning about stocks, different things like that, make sure to subscribe to this channel as this is the first video. And check out the links in the description below if you want to get better detailed videos. I have courses coming out, so make sure to check those out. If you don't want to pay for them, that's 100% okay. I'm not pushing those onto you, but I do believe that they're very valuable, especially for beginner investors. But enough of this talk. Let's get into what is stock option trading. Also, check out the Discord. Sorry, I forgot to mention that. Check out the Discord. Link's going to be in the description down below. It's only got a few spots in there before it becomes closed, so make sure to join in before it gets filled up. Now let's get into this. So to use our example today for how to trade stock options, we're going to be talking about Tesla. And I'm sure you know who Tesla is, the electric vehicle company, Elon Musk. Now, Tesla's stock right now, one share of Tesla stock is worth $1,000, $1,017. That's a lot of money. So in order to trade options on a stock like Tesla, it's going to be very expensive. So we're just going to be using them as an example because Tesla's options are very common in the stock market. A lot of traders like to trade Tesla options. Now let's go ahead and just click on this button right here, Trade Tesla Options. I am on Robinhood right now. I don't use Robinhood myself, but I know that a lot of beginner investors and investors in general use Robinhood, so I want to show you guys. It also has a really good user interface. So let's go ahead and talk about this. So when it comes to trading options, you can do 4 different things. You can buy a call, you can buy a put, and then you can also sell a call and you can sell a put. Now on this one, we will mainly be focusing on buying calls and buying puts, and then we'll also go over what selling puts and selling calls are. But let's get into overall the basics on what is buying a call. So this is, you could own 100 shares, but necessarily you don't need to own 100 shares of the stock yet, and most of the time you do not. So there's 2 different things that could happen. This is where you purchase, whenever you buy a call. Sorry about this. Let's actually get into this first. So let's go ahead right here and you need to know a few things. Main things you need to know is the strike price, this price, and the expiration date. So the expiration date is going to be the date in which your option expires. And that means that if you want to make profit or you want to exercise, which we'll go into that, you need to do it by the end of this day when the market closes. Now let's go ahead and say by January 14th, I want to buy a call. And buying a call means that you're bullish. It means that you think that the stock price is going to go up. So let's go ahead and say I want to buy a call on Tesla stock at the $1,000.45 strike price. Now what that means is by January 14th, I believe that Tesla stock will be at least $1,045 per share or maybe even higher. And now, in order for me to make this trade, it's going to cost me $2,260. So let's go ahead and give it a definition. A stock option gives an investor the right, but not the obligation, to buy or sell a stock at agreed upon price and date. So keep this in mind. It gives the traders the right, like the option, but not the obligation to buy that stock. So let's take this for example. We have Tesla right here. So Tesla's at $1,045 on the strike price. What that means is that by January 14th, if I pay this $2,300, and let's say Tesla stock goes from $1,022 all the way up to $1,100, well, because I paid for this option, I have the right to pay only $1,045 per share. And options work in 100. So when it comes to trading options, you have to understand that you're obligated, and whenever you have the right to, you don't just buy 1 share. You have to buy 100 shares. So you do 1,045 times 100. So that's going to be a lot of money. If you do that math, 1,045 times 100 is $104,500. That's how much money you would need to buy 100 shares of Tesla stock. But then you'd go right back out in the market, and if it was $1,100, you would sell them for $1,100 a share, and you would make $110,000, and your profit would be like $5,400, and then you only paid $2,300 for this option. So how exactly What's your profit? Roughly $3,000. That's how options work. Now, that is what happens when you exercise. And that's when you actually go ahead and you purchase 100 shares of the stock that you bought an option for. And you do that when your stock is in the money, meaning that the stock price is now higher than your strike price. Like we did in our example, $1,100 of the share price is higher than the strike price we assumed. Now, let's take an example just for simple comprehensions. Your strike price is $10 on the option, but the stock is $15. You exercise and you make $5 in profit on each share you sell. That's how you exercise. Or what you do is you sell your option. So that's whenever you just pay this $2,255, and this is what most option traders do, is they pay for this contract, this option contract that gives them the right to buy those shares at this time. And what they'll do instead of actually buying 100 shares is they will just sell the contract. So let's say they buy this for $2,200 and then the stock price rises up because we bought a call. And when you buy a call, the stock price, the option price will rise on your call. So what you do is you buy it and you hope to buy this for $2,100 and you hope to sell it for profit. It could be $3,000, could be $2,200, however much it might be. But the reason that options are very risky is because this $2,200 could go to zero. Because if by January 14th, this is going to be $0. End of market close, no matter where the stock is, the stock could be at $2 million a share. This contract is going to be worth $0 after January 14th on the market close. And that's why options are very risky, because you only have so much time in which you can let your option make you money. Now let's go ahead and talk about buying a put. And that is whenever you are buying a put because you expect the stock price to go down. So if I expect a Tesla stock to go down, let's talk about what do I think would happen there. So I buy a put, and Tesla's currently at $1,020. Let's say I think Tesla's going to be at $1,000. So I buy a put. It's going to cost me $2,430. I benefit from Tesla stock going down. If Tesla stock goes down to $980, buying a put gives me the right to sell this stock 100 shares. So what this does is I could sell 100 shares at $1,000 a share, $100,000 total worth. I'd get $100,000 total dollars, but in order to sell these shares, I would actually have to go out and buy shares. And let's say it went to $980, I would have to pay $98,000, and because 980 times 100, I would have to pay $98,000. Okay, let me make sure I do my math right. 980 times 100, yeah, $98,000 minus the 100,000, that gives me $2,000. That would not be a profitable trade because I would make $2,000 in profit, but then I would be spending $2,400 to make this trade. And these are all just hypothetical numbers. These numbers aren't exact, and I'm just giving you a reference. So buying a put gives you the right to sell the option. So let's take an example for easier maths. Your strike price is at $10 on your option, but now the stock is at $5. You exercise your option, so you sell all your shares at $10 because that was your strike price. And then you go ahead and you buy the shares so you can actually sell them, and then you make $5 profit on each share you sell. And then the other option is to sell your option, which is you just pay $2,400 to buy that options contract, and then the stock price falls, and then you sell this in hopes you could sell it for like $3,000 or a profit. You get what I'm saying. And so buying a put is whenever you're bearish, and buying a call is whenever you're bullish. Buying a put, you want the stock price to go down. Buying a call, you want the stock price to go up. Now let's go ahead and talk about selling a call and selling a put. So as you can see, whenever we're buying these options, we have to pay something. But the people who get paid, it's not Robinhood, it's not your brokerage that's getting paid. It's the person who's actually selling you this option. So if you owned 100 shares, you could do what is selling a covered call. And this is when you're putting up 100 shares of a stock you own at a price that you're willing to sell them at. So let's take an example on Tesla. Let's say I owned 100 shares of Tesla and I kind of wanted to sell right now, but I don't want to sell my shares for any more than $1,070 per share. So what am I going to do? I'm going to go ahead and sell a covered call. And so in order for me to do this, I put up my 100 shares for sale. And once I enter this trade, my 100 shares of Tesla stock will not be able to be traded. And so until January 14th, they won't be able to be traded unless they get exercised in the middle of the option, which we won't get into in this video because we're just talking about the basics. So right here, for me entering this trade, I will get paid $1,455 to do this. Now, the reason that I'm getting paid is because what if Tesla goes up from $1,024 per share, and what if it goes all the way up to $1,100 per share? Well, even though the stock price is currently higher than my strike price, that doesn't matter. I'm still obligated to sell my shares for $1,070 per share. So technically, I am losing because $1,100 is more than $1,070 per share. And that is the risk you take whenever you do sell a covered call, but you do get this minimum credit no matter what. And there is the option that the stock price just stays flat or it doesn't ever go above $1,070. And then what will happen is after January 14th, your shares will get released back to you and you will still keep your minimum credit because you entered the trade, you took on that risk. So you still will have that credit in your account. And then you have what is selling a put. And this is when you're saying that you're willing to buy those shares at a certain price. So you say you're willing to purchase 100 shares of a stock that you could own it, but that you don't own yet, are willing to buy them at, which is the strike price. Let's say, for example, on Tesla, I want to buy Tesla stock, but I'm not willing to pay $1,022 per share. I'll pay $990 per share though. So what I do is I sell a put. And I go ahead right here and I put in a credit. I will get credited $1,900 for doing this trade. But in order for me to do this, I'm going to need to put up $99,000 of collateral. Why do I need that? Because I need to have enough money to buy 100 shares of Tesla, which is $99,000. So I don't know why my Robinhood's getting all like that. But I'm going to need this money in order to enter this trade so that I'm safe and that Robinhood's safe and that I'm not taking on any risk in order to enter this trade. So I would get paid $2,000 now to enter this trade, and that $99,000, it could either go two ways. One, January 14th comes by and Tesla stock is still above $990 per share, which is my strike price. Nothing happens at this point, and I'm going to keep my $2,000 and my $99,000 is going to get released back to me, and I can do whatever I want to do with that. Or option number two, the share price falls below $990, and then guess what happens from there? Then I will have to buy 100 shares of Tesla stock using my $99,000, no matter if the share price even fell all the way down to $935 per share. And that is the risk that you take on with selling options. Now, these are some options terminology I think you need to know. These are just, you could screenshot this if you want to. You got calls, puts, spreads, premiums, expiration date, bids, asks, strike prices, and the Greeks. So we have a call, which is bullish. We talked about that. A put, which is bearish, and we talked about that. The spread, that is the price that sellers are willing to sell it and buyers are wanting to buy it. So let's say buyers want to buy at $1, but sellers want to sell at $1.50. Your spread is going to be $1.50. Then you got a premium, which is the price you pay. So that's like this thing right here. If you want to buy an option, if I hit buy put, I hit this price right here, that total cost, that is going to be the premium. Okay. Then you got an expiration date. That's just the date in which your option will expire, which closes, and it will expire at the market close of that day, which is 4 p.m. Eastern time. Then we got the bid, which is the price that buyers are wanting to buy at. The ask, which is the price that sellers are wanting to sell at. The strike price, and that's the price in which you're willing to buy or sell 100 shares of the stock that you choose. And then we've got the Greeks. And the Greeks is a term used in options to describe the different dimensions of risk involved in taking an options position. There are 5 Greeks that I break down right here. So let's go ahead and talk about what are these Greeks. So as we'll see right here, I will show you just so you can get a look. Let's go to $1,000 on buying a call. So the 1,000, let's go to $1,050 actually. Here are the Greeks. You got delta, gamma, theta, vega, and rho. Let's talk about delta first. This represents the rate of change between your options price and a $1 price change in the underlying stock. So let's make this simple math. If Tesla stock goes up $1, this option contract will go up $38. You just take this number and you multiply it by 100 because every option has 100 shares in it. So if Tesla stock goes from $1,020 to $1,021, this option should go up $37 relatively speaking. Then you got gamma. And this represents the rate of change between an option's delta and the stock price. So let's say that the option goes up in price, $1. Well, if the option goes up in price because the stock price went up, your delta is going to change a little bit. So how much is your delta going to change? It's going to change by 47 cents, which is really not that much. Then you've got theta. That is time decay. So every single day, this option is losing $372. And why is that? It's because it's getting closer to that expiration date. And the closer you get to your expiration date, just the closer and closer you're getting to not being able to make this a profitable trade. So you're going to be losing value because of the time decay. Then you've got Vega. What is Vega? It tells you the rate of change between an option's value and the stock's in the implied volatility. Options with higher implied volatility are more risky, but also provide more return potential. So what this tells you is if the implied volatility went up from 73% to 74%, went up 1%, this option should go up $41 in value. And then you've got Rho. And this measures the option sensitivity to the interest rate. So just like if the Federal Reserve changed interest rates, you really don't need to worry about Rho. But that is options in its basics. So if you did enjoy this content, make sure to subscribe to the channel. Turn on post notifications for all future videos. Make sure to check out the links in the description below. Check out the Discord. It's 100% free right now, but there's only a few spots left before it is very exclusive. So thank you so much for making it to the end of the video, and I hope to see you at the next one.